Good morning. Since there's not too many of you out there, and it's just three of us here on the floor, we would change the rules of the game a little bit. So we will consider all of you as being on the floor as well. So I will ask a question, and then you will ask a question to our participants here.
Okay.
I'm very happy I have the pleasure and the privilege to present to you two esteemed gentlemen from private equity and from venture capital funds. Rafal Bator from Enterprise Investors from Poland, and Adam Kocik from GNT Ventures from Slovakia or Czech Republic? Slovakia. Czech. Damn, I always miss it. Us Croatians and Serbs, you know, we always make such mistakes. Anyway, I'm sure that you very often ask yourselves, if you're not deep in that industry, what's the actual difference between private equity funds and venture capital funds? Because both are actually risk capital, venture risk funds, right? So maybe a few words about those two guys. Enterprise Investors, Rafal has invested together with his team into some companies that you surely know, like Intersport from Slovenia, or Pampek in Croatia, or Studenac Market, right? On the other side, Adam has invested the equity of the fund to also several Croatian companies like Robotic AI, or a company that is hard to pronounce but formerly known as AdScanner. So they know the local market. Adam, what's a VC?
What's a VC? All right. Well, I mean, first of all, it's a pleasure to be here at Shift conference this year. So secondly, on the topic of private equity and venture capital, I think the venture capital is kind of a subset of a larger definition of private equity. So private equity means private equity. So you actually buy a private stake in a company. Now, from that moment on, there are quite a few differences between venture capital and private equity. So I'll take it in very general from the venture capital side, and then we'll move to the private equity. But basically what venture capital does, they discover early stage companies and they work with founders to improve the value, the traction, and then at the end of the day to be acquired, potentially also by private equity, but not only, but also by strategic guys or the IPOs. So basically what venture capitalists do, they acquire minority stakes, and over multiple rounds, they kind of keep maintaining the stakes. So you add another venture capital investor in the next round, and another investor in the next round. So by the time, and the founders usually try to keep at least kind of the 50% plus control of the company at the time when it gets to the borderline, or the company is becoming already big enough or slowing down in terms of venture capital growth, which is what we expect, like 100% year on year. I know it's kind of a dogma. It's not a dogma, but this is what venture capital does. This is the time where the private equity starts playing a role in this process. And then I might just leave it to Rafal to continue with the private equity, unless he disagrees with me, and that's fine.
So private equity invest at this stage, as you said, when the company is a bit more mature. That means that the business model of the company is already tested. We don't take a risk as a private equity of a business model. This is the stage when the business model is already tested and we want to expand. We take less risk. We rely on the founder less. It's nice to have a founder as a partner, but we don't mind to buy 100% of the company. We can hire external team and continue developing this business. Of course, we invest more money, and our ultimate goal is to sell to trade buyer or list the company at the stock exchange.
And yeah, go ahead.
So I'll just on to that. So one of the differences, and there are quite a few, is that when venture capital invest, we bet on the founders and the founding team and the product, and we work with them or help them whatever way we can to get the company running and to get the kind of the financial metrics kind of started and to grow it until it reaches more maturity, where I think one of the, and so in venture capital, we use kind of our own equity. In private equity, there might be also financing involved in like a debt financing involved from the transactions.
Okay, thank you guys for the comprehensive answer. So the standard life cycle of a tech company, because at the end we are on the tech conference here, would be you have a nice idea, you start to run your own company, you get financed, or you are bootstrapped, which means that you're financing yourself. You get some venture money, and after a couple of years, up to, I don't know, 10 years maybe, less-ish, 5 to 10, yeah?
It actually keeps prolonging that period. This is quite, I mean, what used to be kind of a 5 to 7 or 5 to 8 year horizon for venture capital investments and the cycle is now more like a 6 to 10. And if you move to the US, it's even longer. I think, you know, standard venture capital funds are set for 10 years, but now for the past several years, it has been becoming a norm to have a 10 plus 1 year. So that means together 12 years that in order for the company to get to the stage where they can be either sold or IPO'd, etc. So it is extending, which, yeah.
Our horizon in private equity is shorter because we invest in a bit more mature company. We know what we want to achieve. So we need to, let's say, we want to the company develop through next cycle. So our investment horizon is rather 5, definitely not 10. It can be extended to 7, but we would rather prefer to achieve our goals in 4 years.
So you buy the majority stake in the company, fix it, make it better, help them acquire or help them reorganize, and then you sell it to whom?
Usually to trade buyers, because the company reached the stage when it's, okay, if we are successful, significant market player achieving a high market share. If we have a quite good stock market, we can choose whether to sell to trade buyer or list the company.
Okay, but do you ever get to see tech companies reaching the level in which PEs are interested in buying? Because from your portfolio, at least maybe it's just the Polish PE, but majority of your portfolio is not tech portfolio. It's retail chains, it's bakeries, it's different stuff, yeah? But a little bit less of a tech companies I saw there.
This is the nature of our fund. We are quite sizable fund. Our recent fund was €500 million, and simply €500 million is unfortunately too much for technology space in Central Europe. Our minimum deal size is 20 million, so we split our portfolio probably like, okay, technology is about 20%.
20 million minimum size. What's your minimum size? Our minimum size, probably $500,000. I mean, we say 300,000, but it's in reality it's $500,000. This is probably the first meaningful money that a startup can work with to create something. But usually our sweet spot is between 1 and 2 million. We can go up to 3 million at the first ticket, and the potential follow-ons up to, let's say, 4 or 5 million in total investments. So definitely a different ball game.
Yeah. We start from 20 and we don't mind to invest 40, 50.
Now, there's one point that I want to touch on, and this is kind of the role of private equity in also buying venture capital. We've been recently in a transaction that a large private equity firm was owning a company worth hundreds of millions, and they wanted to go to the IPO with the company, and before the IPO, they wanted to kind of streamline everything and make it shining and everything. So they kept buying startups that would fit into their portfolio. And that was driven by also the private equity. So basically the investors, private equity investors in the large company, they also encourage the company to buy smaller companies, startups, to have a really nice value proposition for the public markets.
That's an interesting observation because it's definitely, merging roles that we knew so far were quite different, especially when it comes to the size. But does anybody have any questions so far? Now we know the difference between VC and PE. For instance, those gentlemen in the first row. Oh, there you go. Perfect.
You have the mic?
Okay, so question for venture capitalists. How do you recognize, like, to who or in which company to invest? How do you recognize those early starters? Do you have some kind of like form of analysis of the market to see where are the potential gaps and who can fill those gaps, or what is the case?
So, I mean, this answer can be very long and very short. I will try to give you at least few sentences, but we've been doing it for the last 10 years, and we've developed our internal systems, what to look for. So we have certain criteria based on which we decide. Nevertheless, the markets are changing. What used to be, I mean, the initial ticket, 250,000 10 years ago, is now probably 750,000. So you have to adjust, right? Also, the expectations of the next round investors and the definitions, the right definition for the next round investors is changing. So, but what we do initially, we bet on the founder. And so we look for great founder or a combination of founders. We look for big enough markets. And we look for the markets with sustainable growth. So that means, I mean, the market is 5 billion and it will reach 15 billion in 7 years or 10 years. This is kind of, or bigger, right? And then we look at the product and whether, and then we analyze the competition and then we go a little bit deeper in the analysis. This all takes about a month. Our analysis takes usually a month, and together like 2 to 3 months from first meeting to closing. And then I can continue with these criteria, but these are kind of very important. What we gathered for the past 10 years, that if you're a pre-revenue, if you're a pre-product startup idea stage, that is much harder to raise money. If you're a pre-revenue, it might take you 7 to 10 years to get to an exit. So we look kind of at the stage or MVP or early traction, and we try to help the company to get from low MRRs or monthly recurring revenues to, let's say, 100, 200, 300, 400,000 MRRs, at which point we're pretty sure the company will raise another round or 2 rounds that will increase the value of the company.
Let me add something what is important from founders, companies' point of view, how we look at the businesses. We need to multiply our money. Every fund, when we start from venture, growth fund, private equity, has a goal. Venture would like to have a company which, to achieve a return at least 10 times. Yeah, growth can be 5. In my case, I'm late stage, but still I'm looking for at least 30% growth. If you cannot double the business in 3 years, that's not the business for me. So from that perspective, it's quite important to understand where you are in development of your company. If you slow down your growth, you may be out of interest of any financial investor.
So just to add to the point, that's the difference between us two, VC and PE, is what they consider a good growth is 30%. And 30% we consider a bad growth, pretty much. So, I mean, you know, out of 19 companies in our portfolio in the 2023, 15 of them grew between 50 and 150% year on year. The 50% is kind of to be improved. The 100% year-on-year growth, this is where you start thinking about next round, because you need to have a story, you need to have kind of some figures. If you're looking for the A rounds, it's a 10 million round, you need to back it up with numbers. So that's, and the moment the company gets to over years, let's say if it's 1 year, it's fine, but if it's over years, it gets to 25, 30% growth, this is exactly where we move towards exiting our positions for private equity or for strategic guys, etc.
This perspective applies also to private equity. In your case, if your portfolio company goes bust, you are ready to accept because you aim high. In my case, so far we invested in 160 companies, 3 went bust. And you go bust, you may lose your job. That's, let's say, for us, downsized scenario, it's quite important. 3 times money, but losing money, this is a total disaster. Not acceptable.
And that's another difference between the two industries. The level of risk we're taking is much higher because we're much earlier in the investment process. And yes, I mean, if we look at our portfolio from fund number 1, which was 13 companies, we sold 5, 3 companies died, and that's kind of okay for us. And we still have 6 companies that are in the process of being sold. 2 of them might die as well. But we're accepting the risk. What we're trying to sometimes limit it is, the only limitation we can have is that some priority rights when at the moment of kind of a fire sale for, so we get part of our money back. But we are okay with coming into this game with the 100% risk of losing money in some deals, not all the deals that we're not okay with.
What I like very much about JT Ventures as a VC fund is your level of transparency. So when you check their website, you see their portfolio, and you see very straightforwardly how many companies did their exit and how many died. It's pretty rare in the VC world where VCs usually tend to hide the companies that haven't succeeded. So, which is absolutely great. Please check out their website. But I'm interested in what you said, Rafal. You hate losing money because your tickets are much bigger. Do you have any cases in your career in enterprise investors where you actually didn't make the multiple that you wanted to make?
Yes, of course. Let's say, as I said, we are aiming 3 to 3.5 times money on our investment. I had a deal at 12, and I had a deal when I lost 50% of money invested. But if you look from a fund perspective, if I lose half of what I invested, I need to add this half, let's say half from 20 million, 10 million, to my another investment, and then it's not 20 by 30, and 3 times money means not 60 by 90. Yeah, so it happens. It happens. If you look at our portfolio, we have a lot of deals. Okay, maybe not a lot. We have a segment which is between 1 times money and 2 times money. It happens. Usually, most of our exits are between 2 and 4, and everything which is above 5 we consider as a great. 10 times money in private equity, it's exceptional deal. That happened, okay, it happened twice to me. Once I invested in an antivirus software business, AVG, in the Czech Republic, and we passed the whole journey from entrepreneur, VC, PE, like us. Then we were joined by a global PE, and we listed the company and the main floor in New York. But it's quite rarely private equity are having deals 10 plus.
And it was a tech company.
And it was tech. It was antivirus software business. We invested when the company had $10 million revenue, and we sold when the company had $100 million profit.
What's the biggest multiple that you've seen in your career within JNT?
Within the funds, I think we're somewhere between 8 and 9 times on exit.
That's nice. I will ask you now about the region we operate in, but we have a question from the audience before that.
Hello. Can you guys hear me? Okay, great panel so far. So I also work in both private equity and VC. So I have a question for you about, you spoke a little bit about multiples. But can you talk a little bit about, every fund has a certain return profile to your LPs. Can you talk a little bit about fund construction? How do you think about overall fund construction?
Okay, it's a very current debate that I'm having with my LPs. No, but we're kind of now closing fund number 3. I mean, so we're fund number 1, we're divesting last pieces. Fund number 2 is, we have one or two more deals to do this year, and fund number 3 it will be open or closed, whatever you call it, now in the fall. So you know, it depends on who your LPs are, and that there can be a variety of LPs. What we do, we have some institutions, and we have high net worth individuals. What we see is increasing amount of funds looking at the investments and sovereign funds looking into the investments into venture. But sovereign funds, I mean, bigger venture capital firms. So with the fund of funds, it's a different topic. I mean, they have their own math behind it, how they structure it. But with our LPs, I mean, what we discuss is that they need to gain a certain level of comfort investing in venture capital, and for large institutions, that has been the case to get used to it for the past 5 years. They want to see if we make money, they want to see some preferred returns. So yes, so we have a hurdle rate for them, and then we have kind of our success fee on top of it, and they're quite comfortable with it. I mean, usually the institutional investors, they only allocate a certain amount of their capital into these risky investments, so they're very much okay with the risk. And the high net worth individuals as well. I mean, they allocate 5% of their wealth or disposable wealth into venture capital.
Our fund construction is quite simple. Let's say geography, we invest in countries which joined the European Union recently. So from Estonia to Croatia and Bulgaria. We want to be sizable fund because of our history and track record. So we do almost everything. We are looking for local champions or companies from the region which can expand globally. Like local champion, you may say, okay, Studenac in Croatia, it's reaching the position of a visible company on a local market. In my tech portfolio, I have a software house I invested in a Polish-based company. We made 5 acquisitions, and we are present right now in Moldova, Romania, Argentina, Guatemala, Nicaragua, and recently I bought a company in Kentucky. So we became a global company. Local talents which can sell to a global customer base. This is our message for our investors, and as ticket is high, we are looking for sizable investors, and for sizable investors who usually have a lot of money, they are not looking for like 10 times money. Delivering 30% over, we celebrated 34th anniversary of our business. If you deliver 30% over a long period, that's really a nice return.
Yeah, thanks for the question, because it really, later, Ivo, please. It really cued me to my next question. My next question is the region. So it's a kind of a business that we didn't have in this region 35 years ago. Yeah? So it's relatively new as compared with the Western Europe, let alone US. So what are the obstructions, what are the problems that you're facing in the region? What's the ease of doing business, especially in the countries that have recently joined the EU? And how can you compare those things with your peers and colleagues from Western Europe?
Again, this is a massive question, so I will try to answer parts of it. But yes, I mean, the venture capital ecosystem, and I'm talking about venture capital, but probably private equity is a little bit more established. By the way, one thing, when I was doing my MBA in 2005 and 7, everyone wanted to go to private equity. Then from my colleagues from London Business School, I heard that in 2012 and 13, everyone wanted to go into startups. So there's probably like a backlog of 5 years or more between venture capital and private equity in Europe. But the ecosystem has been evolving, venture capital. And now, I think these days, all the founders, they have all the possibilities in the world to make it happen. And this is a big change from 10 years ago. 10 years ago, there were 3 funds in every country, or 2 funds. Or actually, in Croatia, there are still probably not that many 3 funds. But let's say in the Czech Republic, there were 3 funds. Now there are 12 or 15. And there is a lot of kind of capital and smart money to be used. Now, one thing that is challenging is there is always kind of the perception of Central and Eastern Europe, and this is the region where we invest in, as kind of little inferior in terms of the global venture capital, where Tech talent is much superior. Everyone knows it. Product-wise, everyone knows it. Sales skills, not zero, but not good. And it's interesting that comparable comparable companies, startup companies from Western Europe get much more funding, and that funding gets you to a much faster and higher traction. I'm still trying to figure out why exactly, but I know it. I mean, I've been doing investments in Central Eastern Europe for 20 years, both in, from hedge fund, from private equity perspective, investment banking. But there's this kind of still, the perception of Central Eastern Europe, but at the same time, I mean, all the doors are open, and global investors are looking in the Central and Eastern European region. And if you rely on good venture capital companies, venture capital funds, they can introduce you to those funds. But you need to show the metrics, you need to show the sales skills, you need to show your determination to succeed globally. And I give you a few cases from recent ones. You know, we have various companies that are valued between 30 and 100 million. And the founder, and we see in the founders, sometimes they are satisfied with a 50 million valuation. They said, yeah, I'll make 10 million euros, it will set me for life. While the US founders, 10 million is nothing. They want to make $1 billion. They want to conquer the world. And this is what's keeping us behind the global venture capital ecosystem and markets.
Let's say, to simplify, I see our ecosystem as a triangle. First, innovation which requires investment in science. It's behind my control. I may say the region does not enough in terms of investing in science. I'm a software engineer who graduated in '96. I look across the region. There is no country in the region which double number of IT students over 30 years. It sounds quite obvious for everybody that number of IT students should be, I don't know, 10, 20 times. It's not the case. Yeah, that's behind my control. Second, what is important for us is ability to sell globally. That was a huge, huge problem like 20 years ago, 10 years ago. I had problems to convince any Polish company to go abroad. We were lacking talents in the region with ability to sell product globally. This is what we need. In this area, I see that the region is developing fast. Is it fast enough? We'll see. But that is needed. The third is access to capital. We had our good days 15 years ago when all the countries from the region joined the European Union. The world looked at us and said, this is the region which develops extremely fast. Money was coming here. It's not the case right now. Our growth of the region slowed down. We need to be more attractive for global investors, and we need to convince local people to invest money in VCs, private equity, stock market. So this is what is needed. Like, people should like entrepreneurs, should appreciate everybody who made money, but also everybody should support this market. We need local investors.
Yeah, thank you, great insights both. We have time for just one more question from the audience. The gentleman I happen to know, Ivo, please.
Thanks. Hello. Question for Rafal. Do you see any comparison or any specific differences between the sophistication of the management teams of the companies that you acquired in Croatia as compared to the management teams of the companies you invested in some other Central and Eastern European countries?
I personally haven't invested in Croatia. All these deals, because are not technology deals, are from my colleagues' portfolio. I see the difference across the region. I had companies in Bulgaria, Romania, Estonia, Poland, Czech Republic, Slovakia. I see the difference. For instance, maybe I would say start from weak side of Polish managers. We are lacking knowledge how to sell product internationally. Which, for instance, on the other edge, I see Estonia. Everybody in Estonia, okay, there is no local market. The company from day zero is a global company. In Poland, day zero, first year can be local because you can achieve a revenue. Second is the style of leadership. For instance, Poland, we have great leaders. We have strong, powerful guys who can lead the company. I know Czech Republic less, but for instance, in Poland, you have a leader and the rest of the team follows. In Czech Republic, this is a common sense. The team can discuss every issue and develop solution. It's a different style of management. I see the differences across the region. Romania, they are excellent to selling to Francophone countries, France, Italy. In Poland, we aim UK as the first country to sell, or Germany. In Romania, they have a great knowledge about Italy, France. So these management teams across the regions are different. Second is age of the manager makes a big difference. We have these old-style managers and new teenagers, especially what I said. For instance, in Estonia, global managers from day zero.
That's the beauty of the region, I would say, right? Thank you very much for your time. I hope it was educational for you, and please a round of applause for our beautiful guys here.
It was a pleasure.